Hi, this is Luke Fannin here from AIT Business Faculty, and we're looking at modifications to the auditor's opinion, which are given in the auditor's report in a set of financial statements. And this screencast is an introduction to the type of opinion that's given when there's a limitation of scope. So a qualified opinion and disclaimer of opinion, number 1 there and number 3. And when we're looking at this, we're looking at what factors lead to a limitation of scope. And so I've done other screencasts that talk about audit opinions and talk about errors. So this screencast is looking at where there is a limitation of scope, or what I call sometimes a possible error. So, and I won't in this one have to go through all the material or pervasive rules, because they've been explained already. So this hopefully will be a bit shorter than some of the others. And then after the screencast, I'll look at some past questions in a separate screencast, and I'll be running through them fairly quickly. I won't have to be going through over all the theory. So the first thing you do is establish if there is an error or possible error, limitation of scope. So we'll be looking in this screencast at the limitation of scopes. So a limitation of scope or possible error is where the auditor was unable to gain sufficient, appropriate, so enough relevant audit evidence about an item or items in the financial statements. And in the financial statements, we're talking about the income statement, balance sheet, and the notes stroke disclosures to the financial statements, and also the cash flow statement, statement of changes in equity, statement of comprehensive income. But really it's the first three. There's income statement, balance sheet, and the notes. So this limitation, this inability to gain enough evidence, enough good evidence, is because the auditors were unable to perform audit work they would have liked to do. And so therefore the auditor hasn't gained enough evidence to have reasonable assurance that the accounts are free from error. So there may be errors in that item that's been affected by the limitation of scope. So this is called a limitation of scope. So if there is a limitation of scope issue, you should, in your answer, explain there may be errors with the item, but the auditor does not know for sure because they were unable to obtain sufficient appropriate audit evidence about the matter due to the limitation of scope. So these are examples of limitations of scope, but we'll see more in a second. You should discuss why the auditor wasn't able to obtain the evidence by other means. So always auditors, sometimes if they're not able to get evidence the way they'd like, they should try and get evidence alternatively. So if they're unable to attend the year-end inventory count, can they work back from when they were appointed auditor later from inventory records to get the value of inventory? Is there other means of determining getting the evidence that they need? So, and in these instances there won't be if there is a limitation of scope issue. And the big thing is you shouldn't be talking about accounting rules here. So we looked at errors earlier where the auditor knows that the audit client has done something incorrect, so has not accounted for research and development expenditure properly because they used the wrong rules. They capitalized the whole lot, or they expensed the whole, capitalized the whole lot when some of it should have been expensed. That's an error, and the auditors should describe the rules for R&D. Here, that's not the issue. The issue really is you'll be talking about the limitation of scope. If we look at a scenario and there is no error in the accounts that are in the scenario, or no possible errors stroke limitations of scope, then the financial statements have to be correct, and the auditor will issue an unmodified audit report. That's where they say, in our opinion, the financial statements give a true and fair view, and they might have some extra paragraphs there: emphasis of matter, other matters, material uncertainty over going concern, key audit matters, or they might have to disclose a separate confidential report to the directors on an internal control issue. But that's the unmodified report. But what we're saying here is we're looking at situations where they cannot give this unmodified report. They have to, because there is a limitation of scope issue that's going to be material or pervasive. So in case you didn't see the previous screencast, I'll just leave this up. You can look at it and read it. I'm not going to discuss it anymore. Of pervasive limitations of scope include these examples here. So this is you need to be able to spot these issues in scenarios. So receivables didn't respond to receivable circularization, and not enough other evidence was available. Another type of limitation of scope is where the directors refuse to allow an auditor to circularize key receivables or very important, very high value receivables, and the auditors then are unable to gain other evidence about the valuation of those receivables. That would be a limitation of scope as well. Lack of evidence over tangible assets, and these are pervasive items. So pervasive means 40% of PBT, so the values are quite large in comparison to the profit. If the values were smaller, so if you were able to work out that the potential error, the maximum potential error was 20% of PBT, then you're talking material limitations of scope. So, but these examples are for pervasive, so they're going to be very big examples. So for tangible assets, unable to inspect the assets, physically inspect, as they're held in a foreign location, and the audit client would not pay for the costs of travel and inspection. And then no other sufficient appropriate evidence available. Evidence over closing inventory, and so what you're looking for is it won't say this in the scenario, lack of evidence over tangible assets or lack of evidence over closing inventory. It'll say this, and then you have to know that this means that there was a limitation of scope. The auditor was unable to gain evidence over closing inventory, so therefore you're down the limitation of scope path. So auditors being appointed after the year-end inventory count took place, and then they were unable to gain enough appropriate alternative evidence on the valuation of inventory. Lack of evidence on intangible assets are in these same things. So there was a fire during the year, so really I should have said this first maybe. A fire during the year and all records were lost. So that it would say these kind of things in the scenario about research and development projects and no other evidence available. Then you, on reading that, would go, okay, that's a limitation of scope, and you would say, explain the auditors were unable to conduct all the work they would have liked. There's a lack of evidence over intangible assets. Then you discuss materiality. You'd say the amounts here are very big, 30 million, PBT is 20 million potentially. If all those intangible assets were capitalized, 30 million, potentially all of them, that 30 million might have need to have been expensed, or even if half it should have been expensed, you're talking 15 million over 20 million, which is 3/4 of 75% of your PBT, which would be pervasive. So that's the route you go down, and you write all that down. A key employee left during the year and took vital records with her, and then the remaining employees were unable to answer auditor questions or provide sufficient audit evidence about a particular project. Then that would lead to lack of evidence over project costs, and the auditor, you would then explain that's a limitation of scope, and you'd have to discuss, is it material or is it material and pervasive? And then when for limitations of scope, this is your, I suppose, guidance for determining the audit opinion. So for immaterial limitations of scope where the possible error is less than 5% of PBT, or is qualitatively not material, it's qualitatively material, then it's an unmodified opinion. But really, we're interested, well, you could get that as well. We're interested really in the material items and the pervasive items. You need to, I suppose, be able to spot immaterial as well, but just not to confuse things. So a limitation of scope where the auditor was unable to obtain sufficient appropriate evidence about a matter in the financial statements, therefore there may be errors, and then you determine if the potential error, possible error, is material, if it's greater than 5% or greater than equal to 5% of PBT. but less than 40%, then the auditors would issue a qualified opinion where they say the financial statements are true and fair, except for the possible error in, what example we have, inventory, about which we were unable to obtain evidence on a certain line of inventory. The potential maximum misstatement would be 40,000, which is 6% of PBT, so it's a material matter. A disclaimer of opinion is if the auditors were unable, where it's a pervasive matter. So an example would be, we said the auditor was unable to attend the whole inventory count at year end, was unable to gain sufficient appropriate evidence elsewhere on the value of inventory, and the value of inventory is very large compared to the profit, then the potential write-down could be greater than 40% of PBT. So in that case, the auditors would give a disclaimer of opinion where they say, I'm unable to give an opinion on the financial statements due to not being able to gain sufficient appropriate evidence about closing inventory at year end, the value of which is 5 million. The potential write-down of that is unknown and could be greater than, lead to the profit turning into a loss, or it's enough to make the accounts misleading. And the big thing is on pervasiveness is, does the issue make the accounts as a whole misleading? If it does, then it's a pervasive matter. If the matter just makes part of the accounts misleading and the rest of the accounts are okay, then it's a material matter. And then I spoke about those paragraphs already in the previous screencast. So the next screencast will look at applying this to past questions. Thanks for watching.